resident life insurance guy with Rent to Retirement, and that is Chris Reid. He is a chartered financial consultant, and we're going to talk about life insurance today. And I'm going to make sure I say things the right way. And we are going to talk about index universal life. And we're going to talk a little about whole life and the concept of infinite banking and kind of just the general how to, what to look for, all of those fun and exciting things that people love to talk about whenever they talk about insurance. So Chris, thanks for joining us again.
Yeah, of course, Adam. Good to see you again.
Yeah. So let's go over it again. I mean, people heard, obviously, we talk about this every time. There's, term life, whole life. There's this index universal life you talk about that I, for some reason, always continually call whole life. I mean, if someone hasn't listened to our previous episodes, which they should go back and listen to, but briefly go over kind of what each one is.
Yeah, perfect. So I think infinite banking, like as a concept, and I was just in doing my taxes the other day, and my CPA, who's a funny guy, I swear he's actually been my insurance client for almost a decade. And he goes, oh man, Chris Reid, this whole cash value policy, and he owns one. And he's like, I've got clients just taking tax-free money out. Like, this is such a cool tax shelter. And I was like, man, and I won't use his name, but I was like, you literally know that's what you have. But it just kind of reinforced with me. It just kind of reinforced with me what like a good tool it is, especially for people who are thinking outside the box to like build wealth, invest in real estate, create tax shelters, tax-free money. One of my biggest concerns right now, people like with interest rates going up, people don't understand the debt service that we pay on our national debt, which is $40 trillion at a time when income taxes are at their all-time lows. Like now our debt service is going up. So whether it's investing in real estate or creating tax-free money that the government can't touch, in cash value life insurance just really kind of holds this spot of like an unrestricted Roth. People call it the rich man's Roth, right? Because what you're trying to do is grow after tax dollars and take it back out tax-free later. Whether you do it for real estate in the short term or whether you're building long-term tax-free wealth, it's a tool that can't be touched. Now, I am a fiduciary. I'm a chartered financial consultant. I'm telling you, it's not the cure for cancer. It's not the be-all end-all. But properly positioned in an overall portfolio, it's a Swiss Army knife that has some phenomenal upsides, and it's also got some drawbacks, and it's very important that people are aware of those before they get into it. But I'll share my screen, and I think I'll just kind of reinforce with people, where the whole concept of infinite banking is just kind of this. And so your watchers are now going to be privy to my artistic capability. So I apologize in advance.
Yeah. Just real quick before we get into that, you mentioned that your CPA has a policy like this, but isn't using it. So you might be going into this in just a minute, but when do you know you can get into it? Because I know we've talked before and it's when you first get started, you can't, probably not the best idea. You're not going to have as much there. So why do you think he doesn't realize that he can use it, I guess?
So I only talk on this podcast and videocast with you guys about, it's typically a younger cohort, people with excess money, people who want to build tax-free wealth in the long run and that kind of thing. For one of the drawbacks of any cash value policy, whole life, index, universal life, whatever, is that it takes a while to accumulate that cash for you to be able to use, right? We as a society don't love that. People want to get rich quick and they want to buy that property tomorrow. And I get that. I'm a real estate investor. But for older folks, the conversation I have with people in their 50s and 60s and 70s, there's other benefits of a cash value policy, like a long-term care component. So with my CPA, who's a little bit older, we never really hammered down on like, hey, let's use this cash later tax-free. It was more about, we're going to build this big, gigantic bucket of money that's going to take care of your long-term care needs, take care of your family after you're gone. So it's a very good estate planning tool as well. The reason why he's not chomping at the bit to take tax-free money out to go buy properties is because he's in his later part of his life. What he did it for is the feeling of peace that he has now, knowing that his long-term care is taken care of, because he has cognitive decline in his family. So the reason that you're asking about is we just never framed it up that way. He could use it tomorrow if he needed 50 grand to go buy a property. He could do it. He's just not a young doctor, lawyer, CPA, or like Amazon guy who's like, hey, I want to go buy those rent to retirement properties. Where do I get the money?
Gotcha. Okay.
Yeah.
Different strategies for different folks. All right. That's good to know. I would hate for him to be sitting there thinking on 200 and he's like, where am I going to get money?
No, I'm glad you did just take my 5-minute rant and turn it into a very succinct one sentence. I probably should learn to do that.
Well, no, because mine wouldn't actually help people understand it.
So infinite banking like this. Nick, can you see my whiteboard now?
I'm pulling it up now. Oh, that is beautiful. If you're listening to this on the podcast, you've got to get over to YouTube to see these amazing drawings.
Here's your R2R client, right? And they're happy because they're working with you and they're eyeballing this Cape Coral property over here in Florida. And whatever funding mechanism you guys come up with, they go, hey, wait a minute. You know what I need $50,000 to close on this deal. Well, where do we go to get $50,000? Option number one is the bank of whatever bank you bank at. And I'm just going to use these 3 letters. They don't represent anyone in particular. And you can walk into that bank,
right?
Yeah, you can walk into that bank and say, hey, Mr. Banker, can you loan me $50,000? Well, they'll give you the $50,000 and they're going to charge you like these days plus 8% interest, right? So you're going to go close on that deal. And then eventually you have to pay back that $50,000 plus 8% interest. Right. I think we all kind of understand that. Yep. So the rents, your excess cash flow, whatever is going to come out and pay this back. So the whole point is you pay it down over time and then you build equity in here and you get some free cash flow. Okay, that's awesome. So where the cash value life insurance comes into play, and if you just took the word life insurance out of it, if you just had the bank of you, right? What you need to do, you need to accumulate cash somewhere. So that cash, that can be in a non-qualified, that can be in a taxable brokerage account. There's self-directed IRAs. You could store it up in a checking account. And every one of those vehicles has pluses and minuses. Like a checking account's very safe, but you get plus 0.05%, right?
Yeah, plus 0.9.
So yeah, so a life insurance contract is nothing more than a cash accumulation account where we can build up some cash, borrow our own $50,000, do that exact same Cape Coral deal, but now instead of paying back Wall Street, we're going to pay ourselves back $50,000 plus 8% interest. So now you're making $54,000 if you paid it off in a year. Now you're getting $54,000 back in your account. And then the word infinite comes in because, okay, well, we drained our money out, then we paid our money back. But now once we've paid our money back, now look, now we have $54,000 to use. Well, guess what? We can go do another Cape Coral property. We're going to borrow that money and then we're going to pay it back. And then we're going to borrow, pay back, borrow, pay back. So that's the infinite banking in concept form, right? We're just acting as our own cash accumulation account. Then it just really comes down to where do we want to put that money? If we put it in the stock market, well, maybe we saved up $50,000 before January of this year. And all of a sudden now we have $30,000. That's no good, right? If we put it $50,000 in the bank and just was in a checking account, now we have $50,500. Life insurance just is a place where you can pull the money out. You're going to get more interest. And one of the biggest benefits is you're going to take that loan tax-free. So all that money can come tax-free, and then you're going to pay it back to yourself and keep accumulating a tax-free bucket of money.
So when, and I remember we touched on this back in one of our previous ones, one of the benefits that you discussed then is that the interest rates are lower, especially in today's environment, are much lower using your index universal than they would be going to Bank of Anonymous, right?
Yeah, they are. They're capped, right? So the nice part, and things are shifting, new products are coming out and they're going to readjust this year soon. So like right now is really the panacea of getting into one of these. There was a tax code change under the last administration that allowed you to put in more money per dollar. So even people with old policies that they've been funding, you actually can move that over and get a much, much more beneficial policy that's going to really accelerate your cash accumulation because the tax code changed under the last administration. Now you can put almost in twice as much cash per dollar of insurance. So, I mean, and interest rates are still lagging on the loans for insurance companies. So, people are very acutely feeling the interest rate rise in the real estate market and mortgages and lending. I still have policies with 3%, 4%, 5% guaranteed caps, and that's for life. So if you take a policy now, you can put in twice as much cash as you used to be able to, and you're getting you're getting a bank that can never charge you more than 4 or 5% interest. So if 20 years from now, interest rates are at 15%, like they were in the 80s, you still are going to have access to capital that's at 3 or 4%. So it's ridiculous.
Yeah.
I mean, it's just a good time. It was like things, it's very odd. Inflation has actually been very, very good for insurance products.
Yeah. So let's touch on what you mentioned about putting your money in the stock market. Right now, obviously, we have seen, the stock market drop. I think the S&P is down like 20%. The Dow Jones is down like 10 or 15 for the year. NASDAQ's down 10 or 15 for the year.
30. The NASDAQ is, tech's just gotten gutted.
Yeah. Yep. So when you look at it, how are these able to continue paying out and growing in the life insurance policy? Because it seems like the valuation doesn't drop like we've discussed before, it goes up. So how has that managed to happen in an environment where things are tanking?
Yeah, great question. Well, actually, do you mind if I just share another chart that it's not drawn by me, so people actually will be able to understand it. So what really is going on here? So the red line is the stock market, right? It has very good days. This is the tech bubble here. This is the housing bubble, and this only goes back to 2016. So it kind of depends whether you're in whole life or index universal life. Your money is going to grow in one of two ways. In whole life, you're basically going to get this steady Eddie dividend payment, which is just the board of governors of every insurance company declares every year what they want to pay you, right? It's not sexy, but it's pretty safe. 4 to 6% is typically what we see, kind of no matter what the environment. So here's your blue line. So whole life policies, like in this last year, dividends are still paying. So they've made their 6% for the last 12 months, irrespective of what the stock market has done. Now, those companies' reserves, all their cash on hand has probably depleted because the stock market's down, which means they may have to adjust dividend rates down next year. But during a down market, during that acute phase, they've still gotten their dividend payments. Index universal life is the green line here. It tracks and participates in the stock market during the good years. It locks in the gains. So all my index universal life holders who've been storing up money for the last 2, 3, 4, 5 years during this huge run up right here, they didn't make any interest. They won't make any interest this year. They're gonna post a zero. But then now that we're down here at the bottom, if the market starts recovering, then the insurance companies are going to start buying their options from the low point, and they could see really, really good years ahead of us. So depending on whether you're in whole life or index universal life, really is going to drive how your money grows during up and down markets.
Interesting. All right. So let's get started with, one of the things we wanted to touch on today was the actual, getting started process. So walk us through a little bit about that process, because this is one of the things, you mentioned like $2 for every dollar, all of the things that the tax code has changed. So when you're looking at this, thinking about, understanding this concept, let's say we're talking about somebody in their 30s, maybe makes 100 grand. Realistically, what is a product looking like for that person?
Great question. So the whole process, I think I've been watching House. Did you ever see Dr. House?
Yes.
Like, he's the phenomenal doctor. His bedside manner is like, so when the first thing is people they get interested. They see a TikTok video, they go to infinitebanking.com or whatever it happens. And then they're like, oh, rent to retirement, right? So then they come to me and they have questions. I'm big on education. I'm completely independently contracted. I write whole life and I write index universal life. I write term life insurance. I also, like I said, I try and position all these things very holistically with all my clients. I do not like the pushy sales, TikTok-y, this is going to cure cancer sales pitch. It's dishonest. So the first thing that happens is people book an appointment with me. People who don't have any insurance, whether that's pure protection because they just had a baby, whether they want long-term care, or whether they want to do a big fat cash value life insurance policy for real estate investing. The only thing we do is get together and look at their position. What I want to know is their goals, because their goals are going to drive the whole process and where we go with their money. So people kind of know they need to do something. They think this is a good idea. The first step is just talking to me for half an hour and getting educated. Then they're usually going to go back to TikTok, Google. They're going to read blogs. Everybody's going to tell them everybody's got a dog in the fight. Like, I don't really care. I want people to be happy with what they have and have the best product. And because I'm independent, doesn't matter to me where people put their money. I want them to have their hair blown back by the thing they have in their portfolio. I will tell you unequivocally, some are better than the others. But at the end of the day, when people want something, they get what they want, right? So that's the process. So people with no life insurance, we'll just talk cash value. People, even if they just go, hey, I just need to set aside $500 a month. I know I need to do this. I know taxes are going to go up in the future. Look, I've got a guy who works at Jiffy Lube. He's a client. Took me 10 minutes. Hey, man, do you need to save for retirement? He's like, absolutely, I do. He has a head on his shoulders. Good kid, young. And he goes, oh, I can do $250 a month. And I said, sign here. 35 years from now, because he was like 20 when I met him, 35 years from now, when that kid's 55, he's going to have at $250 a month, because of compounding interest over time, that kid is going to have $750,000 that he would not have otherwise had, and it'll be tax-free. Then I've got a guy in Illinois. He's a big tech guy. He makes about $400,000 a year. He's been working with you guys and is killing it on the cash flow. And he had an old whole life policy. We ran the numbers. We're going to double his cash value by switching products to a better company just because of all those changes. So the process there now, that one requires more education because people get very emotionally attached. And then they go back to their old whole life salesman, and that guy jumps up and down and starts his hair on fire. And so we have to work through all those issues. But at the end of the day, the numbers speak for themselves. So the process for him is different. He goes through the underwriting. So that's the next step. Once you're educated, once you kind of know generally what you want, you have to get approved by the insurance company. If you make $10 million a year and you're 35 and you want one of these and you have cancer, you cannot have one. There's only two reasons why people don't do a cash value life insurance policy. They can't afford it, which is totally fine. I was making $450 a paycheck when I was in the Marines. Like, that, you got to do something, or they can't medically qualify for it. I've had both situations. So the process is get together, meet, have a conversation, do an application and get approved. During that time is when you do all your education. Look on Google. The most important thing is that you communicate with me. Don't go into witness protection. Don't get all weirded out because you thought you wanted to do $500 a month, but oh no, now the budget's changed. We're not going to call Chris Reid back. No, you need to understand what you're getting into. And the only way to do that is to communicate, have your questions answered. And then once everything's done, you're approved medically with the insurance company. You have your budget picked out because these are all flexible premium. You can put in whatever you want. Dual Amazon employees might do $50,000 a year. My Jiffy Lube guy might do $250 a year. Doesn't really matter. At that point, then we get back together on the second or third appointment and you say, you know what? Yeah, let's run the numbers. We run the illustration. You look at it. You're happy. You got to be committed, because with any savings plan, you got to be committed. You tell me what you want to pay and we get it set up. From that point on, do you use it next year for a real estate deal? Okay. Do you let it sit there for 10 years and then pull it out for a bigger real estate deal? Maybe. Do you leave it in there for 30 years and have a big fat bucket of retirement money that Uncle Sam can't tax? Cool. Right. But so it's a very flexible product, and the process is just working through all the questions and making sure you're educated and get the best product.
So what I hear is crash diet to drop the weight and get approved, right? Is that what I heard?
Do not. If you should, absolutely. I will tell you if you're not, people get life insurance underwriting is very liberal. I had a guy who was 66. We were doing the long-term care thing. No, he was 60. He was 64. He was 64. He's like, I need long-term care. I said, okay. We went to one insurance company. They declined him outright off the blood test. They said he has genetic markers for cancer. I really like this guy. I'm not going to give up. I'm an independent contractor. I can go to another company. I picked up the phone, called an underwriter at the other company. I said, hey, he's got this genetic marker, but I really want to get him insured. And she said, well, how old is he? And I said, 64. And she said, well, we don't test for that until you're 65. And I said, hold the phone. I said, I literally just told you on a recorded line that the guy has genetic markers for cancer. She goes, yeah, but we don't test for that till you're 65. So no, if you're 10, 15 pounds overweight, I'm telling you, you can get great ratings with a lot of bad health stuff going on. So no, waiting is actually the worst thing you can do, because I will tell you, having written over like $55 million worth of insurance and 1,000 people, health doesn't get better. People don't stop smoking. People don't drop weight. You're as young and as healthy and as cheap as you're going to get. That's how it works.
All right. Fair enough. Fair enough. So, going back to 30 something, 100 grand a year, let's say they can save $1,000 a month for it to put towards their policy. Realistically, I mean, you told us kind of about the 20-year-old putting away 250. What would you think realistically you'd be looking at whenever they're 50, 55 years old, assuming that they just did the payments and now they've got, they're getting towards the point they want to retire, maybe take some trips with the kids, all of those fun things? Yeah,
actually, great question. And we were going to use this slide for the whole life, universal life talk, but actually it's almost going to pertain exactly to what you just asked. So let's do this. Let's take this Guardian policy right here. So this is a whole life, right? And thankfully, this client had just been doing $1,000, like 10 grand a year for 10 years. So this is policy year 10. He'd been putting in $9,400 per year. And so let's just answer your question. Let's say at age 58, his whole life policy would have had $400,000, $11,000 in cash. Do you see that?
Yep.
So this gets back. So that's decent. Again, I'm not going to shy away from the fact that one policy is better than the other. So if we just go to age 58, what we did with this client, you'll see here his cash value. We did a non-taxable transfer of this money, this $86,000 from one company to another. And this is what happened. So if you look here, that $86,000 came over in year one. We set his premium at the exact same premium he was already paying. And the reason why he switched was because if you look down here at age 58, and now instead of having $411,000, he's going to have $600,000. So that's why he switched. And that's the process. He had to get approved with the new company. Guardian wrote a check to this other insurance company. They deposited it. They credited it. So he immediately had his account value back up. He was still paying what he was comfortable paying. Honestly, he's making triple what he used to. But he just wanted to keep his payments the same. And he did it because he's going to have 30% more cash in the long run, and probably more because this is a very conservative interest rate. But what he was really sold on was this. If you look here, at age 70, he's basically going to annuitize this and pull out $118,000 tax-free every single year until the day he dies.
That's not bad.
You can
retire on that.
You can retire on that. And for me, especially when tax rates could be 30, 40, 50, I mean, who knows, right? Congress can do whatever they want to capital gains tax, earned income tax, tax rates, tax brackets later on. So that's huge for him. He's a good high income earner. The more you make, the more important it is that you have tax shelters. I will just put it that way. We can stem wine philosophically about politics and stuff, but we don't need to. Math is math. So
you talked about earlier how the tax code changed under the previous administration, led us to where we are today, where you could put in more. Has there ever been talk about taxing money that comes out of life insurance policies like these? Has that ever come up and if it has it ever gotten any serious traction that you know of?
Yeah. So we can't predict the future. Congress can do whatever they want. What we can do is look at historically what's happened. I kind of have a two-pronged answer to that. Historically, there's something called TAMRA and TEFRA, and they've rejiggered the tax code section that deals with the cash value life insurance. The long and short of it is it used to be really abused. So Congress has actually addressed the problem of the rich people hiding their money at one point. Literally all they did was put in goalposts on us where we have to buy a certain amount of insurance per dollar. Did they stop it? No. Did it honestly adversely affect anyone? Not really. And why do we think that is? The second part of the answer is, do you think that everyone in Congress who makes 110 grand a year but somehow accumulates $6 million in wealth, do we think they just max out their congressional 401k? No. People with money find places to put it. It just so happens cash value life insurance is the biggest tax shelter on the planet. You can put unrestricted amounts of money. It doesn't matter how much money you make. There's no backdoor Roth. There's no $7,000 per year. There's no, I made too much money. There's none of that. We're not playing hide the ball. Obviously, we're doing it for death benefit first to try and be as compliant as possible. But I'm telling you, like, I wouldn't imagine that the people in power who pull the levers of power will really adversely affect this. Also, the other part of that is every life insurance contract is a contract of adhesion. So under United States law, contract law is very strictly enforced. And the terms and conditions of a contract, like if people take a policy now, even if, and this happened during the last change, if they take a policy now, even if the tax code and things change later, typically contracts that are adhered to by two private parties are left untouched. So what last time they changed it, everyone who had an old policy prior to the change, they were grandfathered in. I would suspect the same thing would happen.
All right. Well, fantastic. Well, Chris, thank you for joining us and touching on these subjects. We're going to continue diving into this in future episodes. Is there anything you want to leave our listeners and viewers with before we wrap it up?
Not really. I just love working with everyone who comes to Rent to Retirement. It's just so great to meet people who are really in the correct mindset, that the 401k, the IRA, look, I do that for people. I'm a registered investment advisor, state of Washington. I do that for people, and the stock market's fine, and IRAs and 401ks are fine, and people should have them. But I love working with people who I meet through you guys, because we all kind of know there's a better way. And we know about leverage, right? And we know about risk reward, and we know about those kind of things. So I'm just so glad that I met, you and Zach, and that you guys do business, and I'm comfortable referring you my clients for their real estate investment needs and that kind of stuff. And I love the fact that you guys trust me with your clients to make sure they have the best stuff in the life insurance realm.
All right. Well, Chris Reid, thanks for joining us. You can schedule a call with him. Go to renttoretirement.com. Click the about, and you'll see the meet the team, and you'll see that beautiful face right there. You can
lucky.
You can schedule a call with him right there. So that's renttoretirement.com. Click on the about, and you'll see the meet the team page, and he is on there. Really appreciate you joining us. Like I mentioned, if you have any questions, you can email them to podcasts@renttoretirement.com, and we'll touch on it. If I can't answer it, I'll send it over to Chris to answer if it's something directly for him. That's podcasts@renttoretirement.com. Don't forget to leave us a review on whatever podcast platform you utilize, and we'll talk to you on the next episode.
Thanks for watching the Rent to Retirement YouTube channel. Check out some of our other videos, like this one, or this one here.